Two tricks that the bank use to make money out of us. Now, when you take a mortgage out with a bank, you assume that they have a pot of money and they lend you the money and you go and buy a house with it. That's the way that you think it works. When in fact, it doesn't actually work like that. What happens is they qualify you to see if you can pay the money back over the terms that you're after. And then they create the debt, they create the line of credit. Basically, it's digitally and nothing's cash nowadays. And they say to the person who's selling the house that you're buying that this person is good to pay the money back. And basically they create the debt off the strength of your signature. They don't actually lend you any money and you give to the other person. They just create a line of credit for you. It's just plucked out of thin air. It's a digital transaction. And the second thing that they do is they take your money and they only need to keep a very small fraction. It's called fractional reserve banking. They only need to keep a very small amount of money deposited with them within the bank. And that's basically regulatory from the government. So say you put £100 in, they can lend £90 of it out and only have to keep a very small fraction. And do you know what they do as well? Even the small fraction that they keep is probably in gold or an asset that is appreciating. And then the other money goes into investments, into commercial loans, into anything else that basically they can make money out of. And again, it's all digital. It's all just created in the internet, basically. It's not actually physically moving anything around. The only thing that physically moves is you putting money in the bank and then the bank buying gold with it. Everything else is just a digital transaction. So if you think that money is an actual physical thing that is not a whole facade basically that's artificially created by man, then you're quite mistaken really. The whole system's built on smoke and mirrors basically. And what's probably going to happen in the future, not what's probably going to happen, but what the banks are probably scared of, is when a digital currency does start look like it's going to move in, they're going to have to try and prevent like a bank run. Because if you think they only have 10% of all the money that's deposited in them, if we're having a massive switch towards a digital currency, or say Bitcoin becomes the #1 currency in the world, everybody's going to go to the banks and withdraw the money. And if they've only got 10% of it, then all the banks are going to go bust. And the banks kind of do stimulate economy because they lend money to people who buy houses, who, well, create credit for people to buy houses. They let you get loans. They let businesses get loans and stuff to buy other assets and grow and expand and buy machinery and stuff. So banks are quite important to the system and the government recognises that. And that's obviously why interest rates are controlled a lot by the Bank of England. But don't forget that mortgage rates aren't controlled by the bank rate. They're controlled by swap rates and basically more commercial lending that goes on behind the scenes. So money, yeah, it's a very complicated thing and it's all very artificially created digitally, really.